Well, welcome everyone. Thank you for joining OneAmerica and Tennessee Brokerage Agency to learn more about understanding chronic illness as well as long-term care insurance options. We appreciate you taking the time today to join us. My name is Carlin Snipes. I'm the Regional Sales Director with OneAmerica, and I'm going to be walking you through the presentation today. If you have any questions, we do have a chat box as I'm going through. Feel free to just type in a question, and I'll watch that throughout the presentation today. And if you have any questions, I'll try to address it as we're going through the presentation. Again, my name is Carlin Snipes, and with that, we'll get started. It's 2:01, so let's get started talking about chronic illness and long-term care riders. So here's a few disclosures for you, and I know everybody is speed readers on the call and have read all of this information and are fully disclosed. So when we're thinking about chronic illness and long-term care riders or policies, there's some differences out there. A 7702B is a tax-qualified long-term care rider, and a 101G is typically called a chronic illness rider. It doesn't have the same tax advantages as a 7702B plan. But today we're going to talk about both of them, just compare and contrast, just so you have the education, know what the pros and cons for both riders are. And with the things that are going on in the marketplace today, especially when we think about long-term care, there's been a lot of changes to the long-term care market. Unfortunately, there's been some negative things that have happened with long-term care related to rate increases, as well as carriers leaving that marketplaces. There's been substantial changes to the product lines that are out there. One of the new things that are out there is a product that we're going to talk about today is asset-based long-term care, which gives the client more options and different things they can consider. It also allows the client to address the use it or lose it objection that you commonly hear when you're looking at a traditional long-term care policy. Because with an asset-based policy, if they don't use it for long-term care, there is a death benefit that would be payable to their beneficiaries, or there is cash surrender value in some of these policies, so if they change their mind, they can get a cash surrender value. Unlike traditional long-term care, the use it or lose it, if you never used a traditional policy for a long-term care benefit and you passed away, that's the end of the contract, and there's no benefit that the client received out of that policy. So these asset-based solutions are becoming more and more popular in the long-term care marketplace. So as I mentioned, the 7702B, the tax-qualified long-term care, and the 101G are very different approaches. And there are, like I said, there are pros and cons to each. And the main purpose today is not to slam one or the other. It's just to make sure we know the differences between the two riders. So you just look at it, two different approaches when it comes to long-term care. So first off, when you look at a 101G policy, that's typically what you're looking at as a life insurance policy that offers an accelerated death benefit for a chronic illness. And that's a 101G. When you're looking at 7702, again, it's a life insurance policy that offers long-term care benefits. It could be a rider that they're adding on it, and it basically what you're usually calling those types of policies are asset-based long-term care policies. And typically, just about any life insurance policy, you can add a rider like this. I haven't ever seen it on a term policy, not to say that won't come around in the future, but typically most life insurance, you can add this type of rider to the policy. And there are also different approaches when it comes to an annuity-based solution as well with these types of long-term care riders. So let's look at the definition of a 101G. What does that mean, actually? It's coming from the tax code, the Internal Revenue Code, 101G, and it just says any amount received under a life insurance contract on the life of insured who is chronically ill shall be treated as an amount paid by the reason of the death of the insured. So really simply, what it's saying is the client has the option with a 101G to accelerate that death benefit for a chronic illness need, simply put. And there are some advantages to these types of policies. Typically, when you're looking at a chronic illness rider, what you're typically looking at is an indemnity-based policy, or some people call it a cash policy, versus a reimbursement. Some chronic illnesses are reimbursement, but the majority of them usually are on an indemnity basis. And there's some advantages to that, and there's some pros and cons when you're thinking about that. One of the things you'll hear a lot about an indemnity policy, and the advantage with that is the bill administration. Because what happens is once the client qualifies for claim under a 101G that's on an indemnity basis, then that carrier is going to cut a check automatically every month and without proof of anything. They're going to start cutting that check every month for that client, and that client is going to use that for the benefits that they need. Now, the bad thing with that, depending on the situation, a lot of fraud can happen with that, because what could happen is that money's not being used for the benefit of the client. It's not being used for that chronic illness that it was set aside for. Also, with bill administration, if you're looking at a reimbursement policy, typically most carriers that offer the reimbursement policy will set it up so they can pay the facility or the care provider directly. That way the client does not have to get involved in that whole bill administration process. It's just handled directly between the carrier and the provider. So that's one thing that's nice with the reimbursement. The other thing that you'll hear a lot with indemnity-based policies as an advantage is that these types of policies allow a client to pay a family member for services. And most tax-qualified long-term care out there today does not allow that. And there's a lot of reasons for that. But for me personally, when I think about it and I own a traditional long-term care policy, one of the reasons I bought that policy was so that my family would not have to take care of me. I have a policy that's going to pay for that care that I need in the future. And my family more than likely will probably assist me, but they're not doing it. They're doing it because they love me. They're not doing it for a salary. But the main reason when you're looking at a policy like this is not so that you can pay your family member, is to protect your family member. And this way your family member becomes more of a care coordinator, not a care provider. So there's a couple things to think about when you're looking at 101G indemnity policies. So now let's look at 7702B, the definition of a 7702B plan. This simply is a life insurance product that provides long-term care benefits that fall under the classification of the Internal Revenue Code of 7702B. And they typically offer more comprehensive coverage than a 101G, and we'll get into what I mean about that in detail as we go through this presentation. But typically, if you're looking at a 101G plan versus a 7702B, then typically you're going to have richer benefits out of the 7702B plan. All versions of OneAmerica's asset care policies are tax-qualified 7702B long-term care policies. So this is just an overview of some of the things we're going to touch on today throughout the presentation, some of the typical differences that you're going to run into when you're looking at 101G plans versus 7702B plans. We're going to hit on marketing guidelines. We're going to talk about the differences when it comes to how they access the death benefit, which is a really important one. We're going to talk about temporary versus permanent conditions, which this one can be overlooked quite frequently. We're going to get into that. We're going to look at the differences when it comes to the tax treatment of the benefits. We're going to touch on the continuation of benefits riders that are out there, as well as claims qualifications. And then I'm going to wrap up with just a couple of side-by-side comparisons of an average 101G plan versus a 7702B and what that looks like. So let's start with marketing guidelines. So when it comes to the marketing of a 101G plan, the term long-term care may not be used in any marketing or sales literature. They're not allowed, if it's a chronic illness rider that's filed under the 101G code, they're not allowed to call that long-term care. And typically what you'll see them call it is chronic illness. They just cannot call it long-term care. So that's one easy way for you to differentiate between a 101G and a 7702B plan, because if they call it long-term care, then it's going to be tax-qualified long-term care. If they're calling it chronic illness, then more than likely it's going to be a 101G. So when you look, again, when you look at 7702B, they'll be able to call it or market it as long-term care benefits. So on the next page, what I'm showing you here is just some examples of some common 101G rider names, and they're all over the place. And the one that jumps out to me is the first one, Accelerated Access Solution. So if I was a consumer looking at this and I saw an accelerated access solution, I would think, golly, this policy does all kinds of important things for me. But it doesn't really tell me a lot about what this policy actually does, but it's a solution. How about Extend Care or Accelerated Death Benefit for Chronic Illness? The common thing that you see in all these rider names is there's no mention of long-term care. There are just different variations, different ways they define a 101G plan. So on this slide, I'm just going to show you two examples of two riders, two 101G riders, and the verbiage associated. And if you look to the left-hand side, you'll see the names of these two riders. One's called an Accelerated Death Benefit Plus rider. The second one's called an Accelerated Death Benefit Life Plus rider. So the only difference in the name is life is on one and one doesn't have life. But let's look at the first example. So what this rider does is advance a portion, doesn't advance all, but it advances a portion of the death benefit in the event of a specified medical condition, permanent confinement to a nursing home, or terminal illness as defined in the rider. Okay, So this rider will give them a benefit if they fall into any of those categories. What's interesting is the next sentence. If the benefit is exercised, interest charges will be assessed and other charges may apply. So they tell you charges will be assessed and other charges will apply, but they don't tell you what those charges look like. You don't know what those charges are going to be until the client actually goes on claim. So that's one thing that I like to warn people about when they're looking at 101G plans, especially the ones that they look like they're not costing anything to the client, so it's almost too good to be true. The cost typically isn't getting hit on most chronic illness riders until the client goes on claim, and that's when they're going to know what that rider actually costs them. Now let's go down to the second example. It's worded a little bit differently. This rider advances the portion of the death benefit for terminal illness, specified medical conditions, or chronic illness. Now this one actually goes into defining what a chronic illness is, and they define it as being unable to perform 2 of the 6 activities of daily living for at least 90 days. And then they go into the similar language as the earlier rider. If this rider is exercised, interest charges will be assessed and other charges may also apply. So another key when you're thinking about 101G versus 7702B is a lot of those chronic illness riders out there can't tell you what the charge is going to be up front. They won't be able to tell you until the client goes on claim. Not all of them work this way, but a lot of them work this way. So we've hit on marketing guidelines. So we know now that with 101G, they cannot call it long-term care. And if it's a 7702B plan, it can be marketed in the sales literature and the illustrations. It can be marketed as long-term care. So with that, let's go on to how they access the death benefit. How do you access the death benefit on a 101G rider versus a 7702B plan? And I think this is probably one of the most important things in this presentation is to get a good handle of how that works. Now, I will tell you, we're going to look at how we access the death benefit on a 101G. This is not for every single 101G out there. Some of them, there's no upfront cost, and there's not a cost associated, so that's different. But I'm going to talk about with the majority of the 101G plans, how they work. So what you're going to see here is that the rider can be paid with an internal cost of an insurance charge up front. That could be built into the policy, or it may be available at no charge. But then, right after that where it says no charge, in conjunction with a discounted acceleration of death benefit, also known as actuarial discounting. So this is where they calculate when the client goes on claim what that cost is going to look like. So that's when the client will know what the cost is for this rider. And what the insurance companies do with these types of policies, they use different factors, specifically age and interest rates, to determine what portion of the death benefit will be available at the time of the claim. And one way for you to know really easily if you're dealing with a 101G or if you're dealing with a 7702B plan is pick up the phone and call the carrier and ask the carrier, what's my client's long-term care benefit or chronic illness benefit going to be if they go on claim in year 10 of their policy? If the carrier can tell you emphatically it's going to be $5,000 a month, you know, exhausting the $300,000 death benefit, then that's going to be a 7702B plan. If the carrier cannot give you a number, if they say to you, well, we don't know, because that all depends on when they go on claim. We got to factor in what the interest rates are and what their age is at that time. You know, we've got to apply this actuarial discount. If they tell you that, then you know it's a 101G plan. The other thing they leave off of this page that I think is fairly important that's going to come into play in the future, because 101Gs are fairly new in the marketplace. They've been around several years, but they're newer than 7702B plans. The thing they don't bring up is claims history. And I think claims history is going to have an impact on what that cost is going to be to the client at the time of claim. So that's something that we'll see going forward when these policies start, you know, hitting claim and how that works. But I do think claims history will have an impact on 101G plans. So here's an example, a hypothetical example of a long-term care policy, a life insurance policy with long-term care benefits, a 7702B, that's the middle column there, versus a life insurance policy with a chronic illness rider. That's a 101G plan. So both policies provide a death benefit of $300,000. So if the client passes away, never needed the policy for long-term care or chronic illness, there's a death benefit of $300,000 paid to their beneficiary. So that's the same. So now we go down to the second row, the maximum benefit payout. So for the long-term care policy, the life insurance with the long-term care benefits, that's going to be 2% per month. So 2% of $300,000 is the maximum they'll pay out for long-term care. So $6,000. So if you go over to the 101G example, forget that underlined section for a moment and just look at 24% of the death benefit. So you think, okay, well, Carlin said 2% per month, so 2% per month, 2% times 12, so that's 24. That's about the same thing. And it does appear to be the same calculation. However, if you look at present value, that's where the difference comes into play. Because remember I said they calculate the actuarial discount at the time of claim. So they're going to use the present value of 24% of the death benefit to calculate what that long-term care benefit will be. So let's say the client goes on claim in year 1. The maximum benefit from a long-term care that they can get out of the life insurance policy with long-term care benefits is $72,000, $6,000 a month times 12, $72,000. What's going to happen if they use up that entire $72,000 is the death benefit is going to be reduced proportionally to $228,000. So the $300,000 is going to drop to $228,000. Now let's move over that row and look at the last column there and look and see what happens to the life insurance policy with the chronic illness rider. They're going to apply that calculation, use the present value of 24%, and they're only going to get $36,000 for long-term care. So the benefit's not going to be as high as the long-term care plan. It's going to be less. But what's really interesting is what happens to the death benefit. The death benefit is actually reduced as if they did take a full $72,000. So that death benefit of $300,000 is reduced to $228,000. And as you can see through the years, what happens, they're going to max out the $72,000 on the long-term care policy, and the chronic illness is going to continue to reduce proportionally, well, not proportionally like the life insurance side of the house, but it's going to continue to be reduced. So the difference is here, the long-term care benefit is richer on the 7702B plan, and the death benefit is going to last longer on the life insurance plan. Because let's say this, what if the client goes on claim in year 1 and they don't need a full $72,000? Instead of using $6,000 a month, they use $3,000 a month. So instead of using a $72,000 long-term care benefit in year 1, they're using a $36,000 benefit. That death benefit is not going to be reduced to $220,000. It's going to last for a longer period of time. So another difference when you're thinking about 7702B versus chronic illness, typically with the majority of the 7702B plans, the client can accelerate the 100% of the death benefit available for long-term care. So in my earlier example, we said the death benefit was $300,000. They can access that up to the monthly maximum up to $300,000 over the life of the policy. So they can get that full $300,000. The majority of the time when you're looking at a 101G plan, they cannot get that full death benefit for long-term care. As I mentioned earlier, the benefits are determined up front at the time of policy issue. That's one sure way you know you're looking at a tax-qualified plan versus a chronic illness, because the carrier can tell you what the long-term care benefits are up front. It's just really important. Again, I'm not trying to bash either one of these plans. I just want to make sure that everybody understands the differences. I was doing a similar presentation a couple of years ago, and I was a big producer in the back of the room, and he'd done a lot of these types of sales, and he leaned over to his agency that he works with, and he asked the guy the question. He said, well, what am I selling? He didn't know if he was selling tax-qualified long-term care or if he was selling chronic illness. So it's just important so you know the differences and know how they work for the clients. So we touched on the marketing guidelines. We know chronic illness can be not marketed as long-term care. We've touched on the differences when it comes to accessing the death benefit. You can get 100% of the death benefit for a tax-qualified plan. And there's some differences on how that's calculated with that actuarial discount. Now what I want to talk about a little bit and spend some time on is temporary versus permanent conditions. And this can be easily overlooked. So when we talk about 101G plans and we talk about temporary versus permanent, the majority of the chronic illness riders that are out there today say that the condition has to be permanent. Now that doesn't mean every single chronic illness rider is worded this way, but the majority of them are worded this way. So the way they say typically is to qualify for a claim, a licensed healthcare provider must certify a chronic illness. And that's pretty generic, that's pretty typical. But most policies, again, will only pay when that illness is likely to last the rest of the insured's life. So when they're qualifying for the claim, this licensed healthcare provider must certify that they have a chronic illness, they qualify, but they must certify that it's it's deemed to be permanent. It's deemed to last for the rest of their lives. Now, the difference is when you look at a 7702B plan, it does not have to be a permanent condition. Again, the client must meet the basic definition of chronic illness, and again, it's going to require a licensed healthcare provider to certify that they qualify for a period of at least 90 days, that they're unable to perform 2 of the 6 activities of daily living, or they're having a severe cognitive impairment. So if they qualify for either of those 2 things, they can qualify for coverage. The difference here is it does not have to be deemed permanent. It can be a temporary situation. And where I've seen this come into play is, what if someone is diagnosed with cancer? They could need coverage. They could maybe not, dress themselves or be able to feed themselves, let's say, for a short period of time, and they might come off of claim, and then they can go back on claim. So that's a temporary situation. It's not deemed permanent. That type of situation would be covered by a 7702B plan. It wouldn't be covered by the majority of the 101G plans. Another thing I'll think about, and I think I covered in the next couple of slides, so I'll save it. Well, let's hit this first, and I'll tell you the other example in the next couple of slides. Certain health conditions will allow the insured to receive benefits under 101G or 7702B. It won't matter, because they basically, the big ones, are the ones that are considered permanent. So if someone has Alzheimer's, or they're diagnosed with dementia, or ALS, or Parkinson's disease, or muscular dystrophy, MS, there's certain conditions that no matter if they were under a chronic illness rider or if they were under a tax-qualified long-term care rider, they would be covered because these situations are deemed permanent and non-recoverable conditions. So either policy is going to work fine if that's what happens to the client. But something to think about, and especially when you're thinking about this, think about strokes. And if you look at the bottom, there's a stat that I think is very interesting. So a stroke victim, so only 25% of stroke victims die shortly after the stroke or need permanent care in a nursing home or other long-term care facility. So what this tells you is 1 in 4 people that experience a stroke will qualify under a chronic illness rider. The other 3 people would not qualify under a chronic illness rider that requires a permanent condition. They could qualify under a 7702B plan because it does pay for temporary situations. So let's go a little deeper. So we're looking at stroke victims. 10% of stroke victims recover almost completely. 25% recover with minor impairments, and 40% experience moderate to severe impairments that require some care. But what you're looking at, if you add that up, is you're looking at 75% of stroke patients would not qualify for coverage under a chronic illness rider that requires a permanent condition. So that's a lot of people that would be impacted because if they had a policy that did not cover temporary situations. So the other example I wanted to talk about when you're thinking about temporary versus permanent is potential accidents. So if you had, let's say you had a couple, a husband and wife, and they were driving and they had a horrible car accident, and let's say the husband couldn't do 2 activities of daily living for 90 days or more, so he qualifies for claim. If it's a tax qualified long-term care, he would qualify for claim, because if it's a recoverable condition, he would not qualify under a chronic illness rider that requires it to be permanent. Another situation you want to think about is people age 75 and older who fall are 4 to 5 times more likely than those aged 65 to 74 to be admitted to a long-term care facility for a year or longer. Now, what that means is they're likely to fall, and they're likely to need care, but they're likely to recover from that situation. Again, a chronic illness rider that requires it to be permanent would not pay in that situation, whereas a 7702B tax-qualified long-term care rider would qualify for that situation. So now we've touched on the temporary versus permanent conditions. Now let's look at the tax treatment of the benefits. What's the differences in how the tax treatment is on a 7702B versus a 101G? Hold on one second. I think I see a question, so let me grab this really quickly. All right, so first question from Nathan. The trend of 101G plans is to now offer plans that pay accelerated benefits without the requirement to be permanent. Most pay indemnity benefits. When you pay for a rider as you go, there's no discounted death benefit. And then Nathan goes on, in these cases, what are the advantages of an LTCI from OneAmerica? All right, so and as I mentioned, when we're talking about these things, they're not every single policy falls into this category. And I do think these things are changing on the temporary and permanent front. The advantages, and I'll talk about the advantages with OneAmerica as we go through. Some advantages come down to the benefits that are payable. We do offer lifetime benefits. That's something that you can't get out of a lot of these chronic illness riders, because a chronic illness rider is limited to the death benefit pool. With OneAmerica, you can get a benefit beyond that death benefit, and we'll talk about that. Another advantage is, I haven't mentioned this, but when you're thinking about 101G, if you have a client that can't qualify under an underwriting situation from long-term care, then their best solution may be a 101G, because the majority of the 101G plans out there do not require underwriting for a client to qualify for that. Unlike an asset-based solution like OneAmerica, we underwrite for morbidity. So if they couldn't qualify for that, they could not get a long-term care benefit that way. A chronic illness rider might be a solution. And then Richard has a question. Had a conflict, so just got on late, about 25 minutes. If available, please send me the recording, and we will be sending out this recording at the end of the meeting, so you guys will get a copy of the recording. So you'll get the first 25 minutes. Okay, so now let's look at the tax treatment of the benefits. We get back to the slide. All right, so when you're thinking about a 7702B plan, and I always laugh when I look at this slide. So if you're having trouble sleeping one late Friday night and you need help sleeping, you can go out and really read the code section 104A3, which references, actually goes back and tells you about 7702B policies, which tells you they're generally treated as excludable for accident and health insurance benefits under 104A3, and therefore income tax free. So that just tells you how and why a 7702B plan, the tax treatment, why they're considered income tax free for long-term care. So now let's look at the tax treatment of the benefits for a 101G. Benefits paid, they're accelerating. So again, they're accelerating that death benefit with a 101G plan. They're generally excludable from income, just like death benefits. But this is the point that I want to make sure you're aware of and understand. However, there may be taxable if the IRS per diem limit is exceeded. So I don't have 2017's yet, but 2016's per diem limit was $340 a day. So as long as the policy didn't exceed a benefit of $340 a day, you really don't have to worry about this at all. But if it does exceed that, then there might be a question in your mind. If you go back to 2014 and 2015, the per diem limit was about, I think, $330 a day, and it stayed the same in 2014 and 2015, and it went up by $10. Typically, you see either staying flat or increasing about approximately $10 a year. So that's where that realm is. And if you want to get a feel for what that looks like in a more of a monthly basis, all you have to do is take, let's say we'll take $340, multiply it by 30 days. And I'm doing the calculation here so we can have that. So you're looking at $10,000 a month for long-term care. So as long as that chronic, $10,200, as long as that chronic illness policy isn't exceeding $10,200 a month, then there's no concern. If it does exceed it, then there might be questions and there might be concerns related to the tax nature. And then at the bottom, you'll see there's a note from our compliance folks. The tax treatment will depend on a number of specific factors, and the policy owner should consult their CPA regarding the tax treatment of the benefits. So many 101G policies will not pay benefits in excess of this per diem limit. So they're structured, so they've got it built, so there's no way that that policy will ever violate the per diem limit. And so that limits that policy to the per diem limit. So they cannot go in excess of, in that example, the $10,200 that I just used. But there are also policies out there that will provide a stated monthly benefit that's in excess of that. And they'll tell you that, but unfortunately, what's really happening is they're only paying that per diem limit. They're not paying you more than that. But there are other policies that will allow you to receive a distribution in excess of the per diem limits, and that potentially could be cause some significant tax consequences. And what I want to walk through on our next slide is just an example. And this is very different. I haven't seen this a lot, but this was a real life case. I believe the lady that bought this policy was a 65-year-old, and the way this was presented to her was, you know what, if you go on claim at age 85, our policy that we're going to present to you can actually pay you an $856,000 benefit for long-term care once you go on claim. And if I was looking at this, I would think, well, that's really good. I'm getting a lot of money, for long-term care. But going back to the per diem limit, when I told you it was $10,200 a month, and we're going to multiply that by 12. So you're looking at $122,400 as the per diem limit, the IRS per diem limit on a yearly basis. If we subtract out the $856,698, she's exceeding that per diem limit by $734,000. Now, I know the per diem limit will change over that 20-year period, but as I mentioned earlier, it's either remaining flat or going up about $10 a year, so it's not going to go up dramatically over this time frame. So it's just something to keep in mind if you're looking at policies like this that offer this max lump sum for a chronic illness benefit, that it will exceed the IRS per diem limits, and it could cause potential tax problems in the future. And with that, we're going to move on to the continuation of benefits rider. We've talked about the marketing guidelines. Again, that means they cannot market chronic illness, cannot be marketed as long-term care. We looked at the differences when you're accessing the death benefit between some chronic illness riders and some tax-qualified long-term care, where they take into account the actuarial discounting, or they're not able to access the full death benefit. Again, we touched on the temporary and permanent conditions and the tax treatment. So let's look at continuation of benefits rider. Some companies do offer these additional benefits on their policies. Most chronic illness riders will allow the client to access a certain percentage of the death benefit per month up to the full face amount, the full death benefit, or a fraction of the death benefit. Again, it depends on the carrier, depends how that chronic illness rider is set up, and it's typically anywhere from 1% to 4% they'll access of that death benefit on a monthly basis for long-term care. Again, and I mentioned this earlier, so let's say the death benefit on the policy was $300,000. What you're doing in that example is limiting the pool of money for long-term care to $300,000. So what you've provided is a limited amount of money for long-term care benefit in the future. One of the things these continuation of rider benefits provide is a benefit that will exceed that death benefit, that life insurance death benefit. So some 7702B policies, including OneAmerica's asset care policies, will provide an option to purchase additional long-term care benefits. And our particular one is called a continuation of benefits rider. They'll call it a COB rider, or they'll call it the rider. And this is a feature the client can give an additional pool of money for long-term care, or they could purchase a lifetime benefit for long-term care. And again, it depends on the client and their situation, what makes the most sense for them. But the question is $300,000, if they were purchasing a $300,000 death benefit and they were accelerating that for long-term care, is that going to be enough coverage for long-term care in the future? So one of the things I mentioned about asset care that makes us unique is our products do provide a lifetime benefit. We're the only carrier that offers an asset-based long-term care policy that gives you this lifetime option for long-term care. And the question is, if there is 50 months of coverage really enough? And when I look at this, I think of my own family and my own history when it comes to long-term care. My grandmother had dementia and needed care for 10 years. My husband's grandfather, very healthy man, he was a farmer. Unfortunately, he had Alzheimer's, and he needed care for just shy of 17 years. So 50 months of coverage was not enough for either of those circumstances. And when you think about Alzheimer's in general, the average length of a claim for Alzheimer's is approximately 8 years. So 50 months would definitely not be enough in those conditions. And this slide is probably one of my favorite slides in all our presentations, and it talks about the problem with averages. And when you're thinking about averages, all an average is a line drawn through data. That's all it is, drawn through the middle of the data that tells you absolutely nothing about the data. So if you look at this, there's probably about 9 dots that actually hit that average. There's a lot below and there's a lot above. So if you were the person that you were buying that average length of coverage and you were that dot at the very top of the middle, it would not be nearly enough coverage. And think about it this way, when you think about your homeowners, let's say you live in a neighborhood that maybe it's on a golf course, and the houses on the golf course are more expensive than the houses that are off the golf course. And let's say your State Farm agent comes to you and wants to talk to you about your homeowners. And he says, you know what, the average value of the houses in this subdivision are $500,000. So I think you need $500,000 of coverage. Well, let's say your house is only $350,000. So would it make a lot of sense that you buy a $500,000 policy for that house? And let's say he goes to another gentleman in the neighborhood whose house is right there on the golf course, beautiful, but it's $1.5 million. His house is $1.5 million, and he says, you know what? You need a $500,000 policy because that's the average cost of the homes in this neighborhood. So it's just something to think about. We think about these averages a lot when it comes to long-term care. I don't think it's the best way to go because you don't know where that client in their situation, where they're going to fall. So is getting an average length of coverage really going to be enough for the client? So last section before we go into just some side-by-side comparisons I want to walk you through is claims qualifications. Hold on one second, I'm going to take a sip of water. Okay, so let's look at claims qualifications. So when you're looking at claims qualifications for a 7702 plan, it's standardized by law. There are 2 ways to qualify. They are unable to perform at least 2 of the 6 activities of daily living, or they're requiring care because of a cognitive impairment, such as Alzheimer's or dementia. So those are the 2 ways to qualify under a 7702B plan. Now let's look at a 101G policy and how that is. Again, it is standardized by law as well, and it's fairly similar to a 7702B, but there are some differences. And here's a couple examples out of a couple policies that we pulled about the way it was worded when it came to claims qualifications. So one was requiring continuous confinement in a long-term care facility or under a written plan of home care and to stay for the rest of the life and stay for the rest of their lives. So that particular one would be one that requires it to be a permanent situation. The second one, confined to a nursing home for 6 months or terminally ill with a 6-month life expectancy. Again, kind of limiting. And like I said, these are just examples of some verbiage. So it varies between carriers and how their claims qualification is worded. Just be familiar with that policy if you're selling that particular 101G, what the claims qualification verbiage is in the policy. When you're looking at the elimination period for 7702B policies, in general, it's 90 days, but it can be shorter. So for example, with asset care, our policy, we have a 30-day elimination period for home health care and a 60-day elimination period for all other services. And typically what we see happen is 2/3 of a claim begin in a home before they ever move to a facility. And the client can satisfy the elimination period for the facility care, that 60-day elimination period. They can satisfy that with their home health care. So typically that 60-day doesn't really come into play as much as the 30-day one does. So when you're looking at chronic illness riders, again, usually it's 90 days with a chronic illness, but again, there's some variances out there. Below are a couple examples. So for example, one is 6 months, and then they put in the parenthetical nursing home usage only. So I mean, that kind of blows that up a little bit. 2 years, and we've seen some that say 12 months in a nursing care facility. Again, just be familiar with that particular 101G policy that you're working with. Just understand what their elimination period looks like. Investing in those 2 policies as compared to the asset care policy, which is a total premium of $200,000. Hold on one second, I see a question. Okay, so one of the questions, Andrew, is this a UL or a whole life-based policy? So our asset care policies are whole life policies that pay a 4% guaranteed rate on the cash surrender value. So the cash value that's built up is at 4%. And then if it's UL, is it guaranteed? It's a whole life policy, and it is guaranteed at 4%. Lisa, I hope you can hear me. I see a note that you said you could not hear me right about the time that Andrew put his question out there. Yes, I agree with you, Andrew. I think whole life is a great solution as well.
Hey, Carlin, it's Catherine. We can hear you.
You can? Okay, okay. Good. I saw Lisa out there, and I thought, uh-oh. I think there might be one other question. Oh, Lisa said good now. Okay, good, 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 good. Thank you. Okay. So in this example, we're just comparing these two, and they're both investing $200,000 in both of these policies. So the death benefit for the husband, and we'll assume this is a husband and wife example. For the husband in the 101G policy is $221,000. For the wife, it's $268,000. What you're going to look at if you go down into what happens when they go on claim. So we're going to assume the husband had a 5-year claim and what that looks like. So his maximum acceleration for long-term care in this 101G plan was 80% of the death benefit. So of that 221, he could access $177,000. Then an actuarial discount for this particular policy was applied, and it was 4.5%. So that discount was approximately $40,000. So that took away out of that 177. So the total amount that was available to him for long-term care benefit was $137,000. Now, if you look at the female in this example, she had a 7-year claim. Her maximum acceleration amount was $214,000. Again, they apply that actuarial discount of 4.5%, which took away about $70,000 of her benefit and left her with $146,000 for long-term care. So now let's look at the 7702 version. So let's look at the asset care and what happened there. The death benefit for that policy is a single death benefit of $246,000. Our policies are joint and survivor policies, second to die. So if you're looking at the individual policies, they do have a higher death benefit than ours. But the difference is the long-term care benefit, and I see a hand, and I'm going to get it in just a second. The death benefit is a little bit less, but what's different is the long-term care benefit. The long-term care benefit is substantially different in this example. So the husband went on claim for 5 years. He had access to about $7,400 for long-term care for his lifetime. So as long as he needed a long-term care benefit, he was going to get $7,400 as long as he needed it. There was no limit on that. In that 5 years that he needed it, that total benefit that was paid out was just shy of $445,000. If you look at the wife and her 7-year claim, again, $7,406 was her monthly benefit. It was available for a lifetime. So she got just over $622,000 in long-term care benefits out of this policy. And between the two of them, you know, this is one policy that's going to pay out just right at 12 years, and they're getting just over $1 million in long-term care benefits out of this policy. Let me go. I see a hand, and I want to get it before I go to the next slide. So with Lori, so this policy can be a single premium or it can be an annual premium. In this particular example that I'm walking through, it's a single premium whole life. So that's exactly what it is. It's a single premium whole life policy that we're looking at right now. But we do have additional options beyond a single premium policy. We can do an annual premium product. We could do a limited pay product. So there's a lot of options when it comes to how the clients want to pay for the policy. Okay, let's go on to the next example. So this is a closer policy comparison, because what you're looking at here is two policies that are tax qualified long-term care policies. And all of these last three examples that we're looking at, they're all true examples. They're not hypotheticals. These are all real life examples. So in this particular example, we're looking at a single female, age 54. She's putting $100,000 into both of the policies. On the life insurance with the long-term care rider, her benefit's $256,000. On the OneAmerica asset care, it's $167,000. Again, you're going to see that policy beat our death benefit. Our policies are structured to provide the highest long-term care benefit, so you're not necessarily going to get the highest death benefit, but what you will get is a higher long-term care benefit. So if you look at the life insurance on the left-hand side with the long-term care rider, the monthly benefit is $5,100. It's available for 50 months. And you can see if she were to go on claim for 6 years, that benefit that policy is going to pay out is $256,000. If you go over to look at the asset care example, her monthly benefit, her maximum monthly benefit is just shy of $6,700. it's available for a lifetime of coverage. So as long as she needs it for long-term care, she's going to get a benefit of this out of this policy. And if she had a 6-year claim, then she's just over $482,000 in benefits out of the policy. Our last example is probably the closest to similar policies, and I do see a hand again, so hold on one second. Yes, Lisa, I'll make sure that Catherine gets a copy of the presentation out to everyone on the call. So we will be sure to do that. So in the last example we're going to go through is just, to me, the closest comparison. So you're looking at a 7702B policy that has a continuation of benefits rider, and we're comparing that to Asset Care, OneAmerica's Asset Care policy, which is a joint policy, which again has that 7702 benefit with a rider. So this is the closest comparison to oranges and oranges that you're going to get. The policy on the left, again, is 2 single policies, where our policy is 1 policy, joint survivor policy. Again, we're putting $200,000, $100,000 into each individual policy on the left side, and $200,000 into the Asset Care policy. The guaranteed death benefit is going to be a lot closer than you've seen in the earlier examples, and actually we're going to beat them on this particular example. The male is 117, the female is 140. Our policy pays out just shy of $300,000 death benefit. Now, if you look at the monthly long-term care benefit for the male age 67, on the left-hand side it's about $4,900. The female is about $5,860, where she's at, and that's available for 6 years each. That's a maximum benefit for 6 years. On the Asset Care policy, you're looking at just shy of $6,000, $4,950. If you want to put $4,950 for the 67-year-old male and $4,950 for the female. Both of these are lifetime, so that approximately $6,000 is available to them for a lifetime benefit. Again, if you want to look at the claims, if you go to the left-hand side for the 7-year claim for the male age 67, he's just over $353,000. For the female, if she were on claim for 7 years, approximately, because this policy only pays out 6 years, so if it was a 7-year claim, $421,000 is the maximum that policy would pay out. If you go over to the Asset Care policy, you're looking at, if it was a 7-year claim for the husband, you're just shy of $500,000. For the wife, again, you're just shy of $500,000. So right at $1 million in benefits for long-term care if they need it for 7 years each. So I'm going to wrap up, but I see a hand, so let me go back really quick to make sure we got all the questions. And if there's anybody else that has a question, I'll be happy to answer that. Okay, I don't see, my question box is not popping up, but I do see the hand. And the main purpose of this presentation was just to give you a good basis of understanding the differences between a chronic illness rider and a tax-qualified long-term care. It's not to say one is better than the other. It's just to understand the advantages and the pros and cons between the 2 policies. There's certain situations that the chronic illness rider is going to make the most sense, and there's other situations where a 7702 is going to make the most sense. So just make sure you understand. Again, we talked about it when we talked about the marketing guidelines. If they're marketed as long-term care, then more than likely it's going to be a 7702B plan, because chronic illness riders cannot be marketed as long-term care. And we've touched on a lot of things, and I know your time is precious, so we'll wrap up. If anybody has any other questions, Catherine, I'll hand it over to you if you want to wrap us up.
Yes, thank you, Carlin. Again, everybody, this is Catherine with Tennessee Brokerage Agency, and Carlin has given us, this is the 3rd time I've seen this presentation, and I'm still taking notes. So obviously there's still a lot of information to learn when offering these products to your clients, and Carlin has proven to be a great resource for us. And so really, if you're interested in learning more about these products or have prospects that you'd like to see some illustrations on, I'm going to be your contact for those product lines. And again, this is Catherine Canaan at TBA. So we're going to go ahead and conclude this at this time, and we really appreciate y'all participating in the webinar today. Thanks so much.
Thank you, and I'll send the presentation and the recording over to Catherine.
All right, thanks, Carlin. Bye-bye.
You're welcome. Bye-bye.